Imagine owning a small piece of companies like Apple, Tesla, or Google, and every time those companies grow, you grow with them. That's exactly what the stock market allows ordinary people to do. But most people avoid it because it sounds complicated. So in the next 4 minutes, I'll explain the stock market in the simplest way possible. No confusing finance language, just the basics you actually need to understand. Part 1. What the stock market really is. At its core, the stock market is simply a marketplace where people buy and sell ownership in companies. That ownership is called a stock or a share. When a company wants to raise money to grow, expand, or build new products, it can sell pieces of the company to the public. Investors buy those pieces. So instead of borrowing money from a bank, the company gets money from millions of investors around the world. And in return, investors become partial owners of the company. Part 2. How people make money. There are 2 main ways people make money in the stock market. First, price growth. When a company performs well, its value increases. As the company grows, more investors want to own it. That demand pushes the stock price higher. For example, if you buy a stock for $10 and later sell it for $20, you just doubled your money. This is called capital gain. Second, dividends. Some companies also share profits with their investors. These payments are called dividends. It's basically the company saying, "Thanks for investing in us. Here's your share of the profits." Some investors build entire portfolios that pay them regular dividend income. Part 3. Why stock prices go up and down. Stock prices move because of supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell it than buy it, the price goes down. Several things influence this: company profits, the economy, investors' emotions, and sometimes prices move simply because of fear or excitement in the market. That's why the stock market can be volatile in the short term. But historically, it has grown over long periods of time. Part 4. Long-term investors versus traders. There are 2 main types of people in the stock market. Traders. Traders try to make money quickly by buying and selling stocks frequently. They might hold a stock for minutes, hours, or days. But trading is risky and requires experience. Long-term investors. Investors focus on holding great companies for years. Instead of chasing quick profits, they let time and growth do the work. This approach is how many people quietly build wealth over decades. They simply buy strong companies, hold them, and allow compounding to work. Part 5. The biggest mistake beginners make. The biggest mistake beginners make is trying to get rich quickly. They chase hot stocks, follow hype, or panic when prices fall. But successful investors think differently. They focus on patience, consistency, and long-term growth, because the stock market is less like gambling and more like planting trees that grow over time. So, here's the simple truth. The stock market is just a system that allows people to own pieces of businesses. When those businesses grow, your investment can grow too. And over time, those small investments can turn into serious wealth. The key is not timing the market, but staying in the market long enough for it to work.